Why do you think most beginner investors lose money? The secret might be a mistake you're making too. Stop now and learn the right way. To be honest, many of us dream of achieving our dreams by investing in the stock market. But where do we begin? And what mistakes might we be making without realizing it? This video will show you step by step how to avoid these mistakes and achieve success and profit in the stock market. Profit in the stock market is like mining for treasure, but starting the journey without the map and secrets is dangerous. In this video, we will uncover that missing map. We'll clearly examine the mistakes many beginners make and provide real solutions. Are you ready to start your expedition? Firstly, we will explore what is meant by stock market. Simply put, the stock market is a global platform where companies sell shares, and we can purchase them to become owners. Buying a stock means owning a small piece of that company, and it's not like gambling. Instead, as the organization prospers, your share and value grow too. Sometimes, companies may even distribute profits to shareholders as dividends. This all takes place in major stock exchanges like New York and London. Are you ready to begin? As we've comprehensively grasped the essence of the stock market, we will now delve deeply into the compelling reasons behind purchasing stocks. This exploration will be illuminating. So, why should you buy stocks? One of the primary reasons is to protect your money from inflation over time and ensure it grows. Additionally, purchasing stocks makes you a part owner of the company. This means you can profit from its success, and sometimes even receive dividends. This entire process is a significant step on the path towards financial freedom. In connection with that, let's consider the advantages of investment. So, why is investing in the stock market so crucial? The first and foremost reason is to achieve financial freedom and grow your wealth. Allowing your money to sit idle permits inflation to erode its value. Through investing in the stock market, you put your money to work for you, meaning you can easily achieve your financial goals over time. Additionally, becoming a part owner in numerous companies provides direct participation in the economy. It's not just about being a mere consumer. When done thoughtfully and strategically, investment can be a transformative journey. If you enjoyed the video, please subscribe to become a part of our community. Next, we will conduct a deep dive into the common pitfalls and mistakes that many beginners encounter when investing in the stock market. Now, let's turn our journey to stock market mistakes. There are many errors we make without realizing them, but they come at a high cost. So, we've categorized these mistakes into three main categories. First, lack of knowledge. Second, emotional and psychological influences. And third, strategy deficits. Now, let's examine each of these categories one by one, supported by real-world market examples. By identifying these mistakes, we'll explore how to avoid them and become better investors together. 1. Lack of sufficient knowledge. The first and most critical mistake many make when entering the stock market is a lack of sufficient knowledge. This means not understanding the essence of the market, how it works, and its fundamental principles. A knowledge deficit can lead to uninformed decisions and catastrophic consequences. For instance, the collapse of Enron serves as a prime example. Many shareholders lacked the sufficient knowledge to grasp the company's complex accounting practices, leading to massive losses. Entering the stock market without proper knowledge can put you at the risk of similar dangerous scenarios. Therefore, a lack of knowledge is one of the biggest challenges we face when investing. 2. Emotion and psychological factors. The next critical mistake is being driven by emotion and psychological factors. Fear, unchecked greed, panic, and even pressure from family and friends can derail you from rationality. Fear, one of the most potent emotions in the stock market. Fearful investors, driven by the fear of losing their savings, hastily sell their stocks, which can trigger further price drops and market instability. Greed, on the other hand, greed pushes investors toward overly optimistic investments. This irrational emotion can lead to inflated prices and market bubbles. Panic is the highest degree of fear. During market downturns, investors struggle to make rational decisions and rush to sell everything, further exacerbating the market decline. Peer pressure can be a powerful force, compelling individuals to conform to the investment decisions of others. For example, the widespread buzz surrounding a particular stock may tempt you to invest, potentially disregarding your own financial goals and risk tolerance, leading to misguided choices. The dot-com bubble of the 2000s is a stark illustration. Emotionally driven, many investors committed to technology companies with unproven profitability, resulting in substantial losses. They followed the prevailing hype without conducting thorough due diligence. Ultimately, successful investment mandates understanding and mastering these emotions, as independent decision-making is paramount. 3. Lack of strategy. One of the most significant pitfalls for beginner investors is the absence of a clear investment strategy. Entering the market without a plan is like navigating in the dark. Jumping in without a plan. Many novices are tempted to jump in purely by observing market highs or lows. Following momentum trends can seem like a path to quick profits, but without a long-term strategy, the risk of significant losses is high. Without a clear strategy, it's easy to be driven by emotion and make erroneous decisions. Poor portfolio management. A portfolio is a collection of investments. Beginners often make the mistake of concentrating all their funds in a single stock. This is a high-risk approach. Successful investors diversify their portfolios across different sectors to mitigate risk. For example, Blockbuster's inability to recognize and adapt to market changes and pivot to digital platforms with a strong strategy ultimately led to its demise. This highlights the danger of not considering current trends. In contrast, General Motors faced a major crisis in 2009 but managed to reorganize with government support and a robust strategic change, demonstrating that with the right strategy, even significant crises can be overcome. Ultimately, to be a successful investor, it's essential to develop a clear strategy, effectively diversify your portfolio, and stay current with market trends. Next, let's consider potential solutions and strategies for the mistakes and challenges we mentioned earlier, in sequential order. Venturing into the stock market is like navigating an uncharted ocean. To avoid being a mariner without a compass, sufficient knowledge, strong emotional control, a clear strategy, and professional advice are crucial. Here are detailed solutions. First, knowledge and awareness. Gaining adequate education and understanding is the first step. Study finance, market analysis, and long-term investment strategies. Also, grasp the importance of portfolio diversification to mitigate risk. Second, emotional control and resilience. Fear and greed can lead to poor decisions. By controlling your emotions, adhering to a predetermined strategy, and focusing on long-term goals, you can avoid being influenced. Third, clear investment strategy and professional advice. Developing a clear strategy is paramount to navigate the market. This involves defining your financial goals, assessing risk, and crafting a long-term plan. Additionally, consulting with a financial professional can provide valuable insights, leveraging their experience and expertise to guide you. Remember, the stock market journey is not a race to instant wealth. Instead, it's a strategic pursuit that demands profound knowledge, unwavering patience, and a long-term vision. Success is cultivated through continuous learning and disciplined strategy. Learning from our mistakes is paramount. Success is forged through acquiring comprehensive knowledge, maintaining disciplined emotional control, implementing a clear and tailored strategy, and seeking professional financial advice when necessary. This strategic approach paves the way for enduring success. Thank you for watching this video. Please share your comments and questions below. Also, don't forget to share this information with friends and family who might find it helpful. Subscribe to support us and receive more valuable content. Like, share, and subscribe.